Well, I think even with modest rate increases factored in along the lines of the 3 or 4 that most Federal Reserve policymakers seem to be indicating is their kind of base case at the moment, that still probably leaves inflation around the end of next year, around the end of this year, early next year, around the 3% point. So still well above target. We're through the pandemic now, and increasingly we see more moves towards reopening. Normalization, economic normalization is going to be the case, and I think it's very much the case in many jurisdictions that overly stimulative monetary policy is just no longer needed. So we need to adjust for that, and we need to adjust for the added pressures from inflation that we're seeing right now. So there's a double whammy issue here, I think, from the monetary policy perspective. It's a case of removing the excessive accommodation that was put in place around the world to combat the COVID slowdown. And we have the added impetus for monetary policy tightening from inflation.
But Shaun, sorry, let me please try and make it a little bit more clear in my head. You say that we are on the cusp of the inflationary problem. And as Mr. Bostic said, he's expecting it to start to evaporate towards the end of the second quarter, third quarter. 7 interest rate rises in the course of this year takes us to the end towards the end of the fourth quarter here. What are the chances of overshooting here in terms of strangling not just strangling the inflation problem, but strangling the economy along with it? Because we're looking at the 20-30-year treasuries at this point in time, and we're not seeing any signs of any panic there. In fact, we're seeing suggestions that perhaps this may be, to revive an old term, a somewhat transitory inflationary period. So wouldn't 7 be a little bit overkill? Wouldn't that leave us next year in a position of having to try and reignite growth again?
Well, I think another consideration, we're talking a lot about inflation here, but we haven't really talked about the labour markets. We had very strong labour market data last week, and I think one of the other considerations for particularly the Fed at the moment is the fact that the labour market is very, very tight, and we're seeing upward pressure on wages come through in a fairly significant way. So I think, as I say, getting interest rates up a little bit shouldn't be too hard as we move through the sort of post-pandemic environment. Hopefully, we're looking at the tail end of this situation now. But a little bit more monetary tightening, I think, is probably going to be appropriate to address some of these issues and to keep inflationary pressures in check. Now, the cusp of inflation that I was talking about is...
How do you explain the 30-year? How do you explain that, the spread in the long end?
Well, I think, we've been kind of... I'm not a fixed income strategist, but I think, one of the issues that we have been talking about and the market has been concerned about throughout this process recently is just the fact that long end rates just have really not moved, and the curve has tended to flatten and not react to the signs of monetary tightening coming through in the way that we'd normally expect, perhaps in previous cycles. I think there are reasons for that. Perhaps the fact that there is still tremendous demand. We can see tremendous demand for fixed income product from asset managers. I think that's one explanation we've seen recently. Clearly, money moving out of the equity market into fixed income as equity market volatility has picked up. But this is a situation I think that is going to resolve itself over the long run. Difficult to address right now. And not necessarily my bailiwick, but I think longer term interest rates probably will have to rise. We've seen the 10-year rate get close to 2%. It probably has to go a little bit more than that. We expect 10-year rates to be well above 2% as we go through this process.